As I anticipated last month, the Reserve Bank has moved on the cash rate by dropping the cash rate lower. We are now at a stage where we're in effectively uncharted territory with a cash rate as low as what we've got it. It's an interesting time. So on balance, what they've looked at is they've looked at the inflation data. Now, usually what they'd like to see is the inflation running between 2 and 3%, which means that the economy is growing and the capacity in terms of way in which a capitalist economy moves. They like to see that sort of inflation underpinning that growth story. But we saw that running at an annualised figure of 1% with the quarterly number at 0.4. So it wasn't the deflationary number that we had, earlier this year. And that's basically giving us some ability to move forward. So cash rate's now been lower. So what does that mean? What it means is hopefully the Australian dollar will then pull back a little bit more. Great for exports. And again, this is all about job creation. So, the byproduct or the negative product is still this potential for asset appreciation that's going to be too high as we make money cheaper. And then the other big consideration we need to look at is, are the banks going to pass on the full percentage cut, the 0.25? If they pass that on, then that's going to be good news for borrowers right across the board. Some might say that there might be some argument to only pass on a portion of that, but it's a very competitive mortgage market out there at the moment. In fact, what we did see in the lead up to this decision is several lenders actually dropping rates before to try and get in early to try and attract a bit more business as they're seeing the overall lending market slowing. We still need more lending from business. So come on, business out there, get behind your vision, get behind your business, go and expand. This is the time to expand, take on those challenges, because the big payoff is when the economy does fly, your business is going to be well positioned to take full advantage of that growth cycle. So it's really important to understand. Okay, in terms of property again, I want to just harp on this point. I am concerned still around the oversupply story that we're going to see in high and medium density accommodation, and certainly some of the price acceleration that I'm seeing in the outer suburbs, in those sort of greenfield estate areas. That's a little concerning for me, because obviously the mentality is now with these low interest rates, more people are hopefully entering the market, which is great for construction jobs, great for tradies, great for retail sales in terms of, buying all of that homewares that we need to make a house a home for ourselves. But on the other side of that is, are we going to overshoot the valuation? And then when we see the correction and the higher cost of money and higher interest rates, because remember, a mortgage is for the long term, usually 20 odd years or more, we don't want to be caught up in then being not able to afford it. Now, what it does mean, I think, in terms of wrapping this up, is we are definitely going to see interest rates lower for longer. So, between 1993 and 2007, we saw interest rates averaging around that sort of 7 to 7.5%. What I think we will see for at least the next decade is interest rates, sort of probably hovering between maybe 5 and 6% as an average over that time. So, that's potentially good for stimulus, but in terms of actual real growth, real improvement into our living standards and the wealth that we hold, well, if it's just pushing the value of these assets up artificially for the short term, we may not see that wealth pass on to our households in the future. So asset selection is still going to be absolutely critical in terms of when you're looking to invest in property. So let's wrap it up. Rates down, the government is looking to stimulate the economy, that spare capacity, they still want to see that moving, and they thought they'll move now rather than doing something later to get that stimulus to flow through as we lead into better weather and hopefully more spending and right into the Christmas period. So, as anticipated, we got that. Is this the last of it? Well, I think that's going to come down to the global story and then the broader consumer confidence and sentiment that we're seeing out in the marketplace, as well as where inflation goes. So by dropping this, we might see a little spike in inflation, and the RBA will be happy with that as we move away from any deflationary pressures that we have. So that's a wrap for this month.